Good evening, this is Gavin Martin here from Cornerstone Wealth. I'm here facilitating the 2015 Transition to Retirement webinar for Christian Super. Thanks for joining us this evening. Nathan, the Chief Member Officer of Christian Super, will join us to intro the session shortly. In the meantime, if you do have questions, the best way to ask questions is via the chat section on the generally it's on the right hand side of your screen. I think you can move it around, but there's an orange button with a white arrow in it, so if you press that button it either collapses or expands the control panel, and in that control panel there's a chat section or a question section, and you can put your question in there. And Jenny's come through with a question already, and since we've got a couple of minutes before we start, I might actually answer it. So Jenny, thanks for the question. And the question is, do you still earn good returns on the money you transfer into your transition account? And you do. You've got the same investment options within both the superannuation accumulation phase and the superannuation pension phase. So I can answer that question off the bat. Just to ensure that you can all hear me okay, it'd be great if a few of you could just let me know that you can hear me okay, just using that chat section. Be much appreciated. Sometimes we do have some audio difficulties, but just good to confirm that you can hear me okay. Jenny says she can hear me. Stephen, thanks. Ruth, fantastic. Thanks for your feedback there. That's great. And Kay Leong, thank you. John, fantastic. Keith, great. Thanks for joining us. That's great. And thanks for your engagement there. Oh, Nath, I think I can hear you online. Yeah?
Yeah, I'm here.
Hey, how you travelling?
Yeah, going well.
That's good.
Well, that's probably not entirely true. We're fighting the cold.
Oh, yeah. Picked up from the kids or work? What do you reckon?
Yeah. I can't decide. There's a few guys in the office who got it, and my kids have it as well. So I didn't stand much of a chance.
Yeah. We're on to one of the most. I think it's the most interesting topics, or the most in-demand topics, the one tonight. So we've got over 125 people registered, and the people online the numbers online are quickly increasing. So it should be a good one tonight.
Well, yeah, that's reflective of what I see when we go speak at schools and the likes. A lot of questions on transition and retirement and the benefits that individuals can receive from it. Yes,
yeah. And it's by far the most common strategy to implement to, save multiple thousands on an annual basis. So just because of that as well, I think it gets a lot of attention too. Yeah. Have you got anything to talk through or announce this morning, or this afternoon, this evening before we get started?
Yeah, we got statements coming out next week now, so it's coming very close. Our member care team are getting all trained up and ready to take your calls as you receive your statements. I'm sure you're going to have, well, maybe not all of you, but maybe not everyone, but some of you will have questions that you need answered. I was with our member services manager today talking through some of the frequently asked questions and trying to think ahead what they're going to be. So if you're signed up for e-statements, you should receive your statement early next week, and by the end of next week, the first lot of in the mail Australia Post statements will be getting to people. So that's good. This is the earliest we've ever done them in my time here at Christian Super, and I'm fairly confident it's the earliest time we've ever done it.
Yeah, fantastic.
When I started back in 2008, it was the statements were going out in mid-October. the financial year statement. So now to be able to do it in less than 2 months after the year end is really good.
Fantastic. And what were some of the high-ranking questions coming from statements? Did you discuss those?
There's often, so often the most common thing, which is a good thing from us, is, I looked at my statement, I realised I haven't updated you on my address, or I haven't updated you, I've got married, or things like that, which is good. It's a good use of the statement to remind you that you need to keep us up to date on those sorts of things.
Yeah.
We often get questions about the level of insurance members have, and just members getting a better understanding of that. And also a common one that can be difficult to get a head around is the difference between the fees that are taken to operate the super fund and the taxes paid to the...
Yeah, go on, sorry.
and the taxes paid to the government and the premiums for insurance. It can often be difficult really to understand who's taking what. Yes. I guess. So we often get questions around that and trying to help members understand that better.
Yeah, that's good.
We actually just were sponsored this is unrelated, but we just sponsored a school down in Melbourne where you are, they're doing a 40-hour marathon in honor of, as part of 40 Hour Famine for World Vision.
Oh, is that Donvale Christian College?
Yeah, Donvale. Yeah. And so as part of our sponsorship, we've committed to, because they're doing this marathon and trying to run the distance to Bangladesh. So we've committed as an office to do 100 kilometres over the next 2 weeks. So me and some of the other guys in the office are going to be running or walking before work or during lunch as part of our helping them out with their cause. So that's going to be a bit of fun over the next 2 weeks.
Fantastic. You might have to shake off the cold first before you put too many Ks on, you reckon?
Yeah, that's right. We'll see how I go. Sometimes it works both ways. Just I start running and it opens you up and gets rid of the cold quicker too. So. Yeah,
that's good. Yeah. Thank you to those of you who have just joined us and wondering what we're talking about. It's Gavin Martin here from Cornerstone Wealth, and I have Nathan, the Chief Member Officer of Christian Super, with me also, who's going to intro the session at 8:30. If you do have questions, then the best way to ask those questions is via the chat section of the control panel. There's a little orange button that's got a white arrow in it that you can either press to collapse or expand the control panel. But within that control panel, you can ask questions via either the chat section or question section. So that's the best way to ask questions. I can open up, but I generally do it later on after the main content to ask questions via audio if you've got a microphone to do that. It's actually the question section, so under the question section, if you type in there, I'll get that and I'll be able to answer your question there. Jenny, I just picked up your other question about when you can access the money in your TTR. I'll continue on with that, answering that later on. If I don't remember, just ask me again. And we've just got a couple of minutes before 8:30 on my clock here. So just almost ready to get started. But
yeah, almost there.
And I think it was on the Christian radio station down here, Light FM. They were broadcasting from Donvale Christian College, and so I heard about it from that. Yeah.
Yeah, we've just actually started a few new ads on some of the metropolitan Christian radio stations, so you keep an ear out for them if you're on Light in Melbourne, or Hope in Sydney, or some Vision FM in some of the other capitals. So you can hear those new ads that they've put together, which outline some of our investments and some of our ethical positions when it comes to investments.
I think the key message that I heard from some of the radio ads was getting two returns. So not only a return on your superannuation money, but also a social return, providing some impact socially as well. So, yeah.
Yeah, it's just an amazing opportunity. I mean, I was just reading an article today where our chief investment officer was in this roundtable with a couple other investors talking about impact investments and how it's just a great thing that we can help people in the other side of the world through micro enterprise break the poverty cycle while still returning good risk adjusted returns for our own retirement. Like it's fantastic that we can do that, and we hope more super funds are able to come on board.
Yeah, exactly. It's clicked on 8:30, so if you would like to intro the session and even pray if you would like to, we could probably get started. Yeah.
Well, thank you everyone who's here. I'm just having a quick look at how many people there are here. It's great for you to join. We really enjoy having these sessions where we allow in the live format where you're able to interact with Gavin and myself. Gavin is from Cornerstone Wealth, and he helps us out at Christian Super with some of our educational aspects. And he's a great financial planner. He works with a number of our members on not just their super, on their whole, all their financial aspects of their life. And tonight he's going to present to us on transition to retirement and strategies you can put in place to start to scale back the amount of work you do and how you can use super to assist you in that venture. And also there's going to talk about how that can also be used to be quite tax effective for you as well. But before he gets into that, I will just open the evening in prayer. Dear Heavenly Father, we just thank you for your daily provisions, Lord. Lord, we thank you that we can enter your presence, Lord, and have a real and tangible relationship with you, Lord. Lord, we thank you for everything you give us, Lord, including our super and retirement savings, Lord. And Lord, I just pray that you help us to be good stewards of what you've given us, Lord. Lord, I pray these sessions will be full of wisdom, Lord, that is going to be able to be used to further your purposes in this world, Lord. Lord, I pray for each person here, Lord, that they continue to push closer to you, Lord, and Lord, that they continue to seek out your purposes in their lives at this time. Lord, we again thank you for your daily provisions, and we pray this is a good night. In your name, amen.
Amen. Thanks, Nath. Really appreciate that, and really appreciate introing the session. And you'll be here for a little bit. Sometimes I don't close polls and things like that, so if you do notice that, then it'd be much appreciated. And if any of you do have questions, then please feel free to use the chat section on the right-hand side of the screen, and Nath will be here at least for at the start of the session and may be able to answer some of your questions there as well. So thanks very much for joining us this evening. So tonight I just need to run through the disclaimer, which is that tonight's presentation is advice of a general nature only, so you need to seek your own personal advice and make sure that it suits your particular situation. If you do want personal advice, then we can provide that to you, and the way that we do that is we have you complete a questionnaire first, then we meet with you to discuss your goals, what your current situation is, and the pros and cons of the range of options available to you. If it's warranted, we can provide specific advice in the form of a statement of advice, a written document. We can help you implement that and provide ongoing advice. So you can basically take this process as far along the process as you like. That's if you want personal advice. So tonight's webinar is one of a series of 3. So we've already had the retirement planning one, which is really about how much do I need for retirement, what are the phases of retirement, some of the non-financial matters relating to retirement. If you want to access that information, then you can go to It's sitting on the Cornerstone Wealth website. So you go to cornerstonewealth.com.au/retire 2015, and that will get you the recording of the previous webinar. But if you want to register or access any of the recordings, then the best place for it is the Christian Super website. So christiansuper.com.au/member webinars, member-webinars, and there you'll be able to register for future webinars, and also be able to look at the previous recordings on other webinars that might be useful for you as well. So tonight's session is really about how to transition to retirement, and it's one of the most popular strategies to save tax and build retirement savings, and one of the most popular subjects, most popular strategies in financial planning, I would suggest. So the one after this one, on the 7th of September, is getting a little bit more specific, and it's about managing capital gains tax. If you're selling an asset, selling an investment property, for example, how do you minimise the capital gains on that? And then also making sure that you pass on as much as the wealth that you have to your beneficiaries as well. So it's a little bit more specific and technical, that next one, but if it's relevant for you, it might be well worthwhile participating in. As I mentioned earlier, if you do have questions along the way, please put them in this chat section on the right hand side of the screen, where this arrow is, and I'll be able to either answer them throughout the presentation, or I'll defer it to the end of the session, depending on the situation. I generally like to just get your feedback on the age of everybody. I think there'll be a large portion in the 50 to 65 year old age group, but if I can just check that to make sure that I need to, whether I need to tailor things a little bit more, that would be much appreciated if you could just submit your age there. Elspeth, just do it via the, you can actually press it on the poll there rather than via the chat section. So here you go there. We've got about 94% voted, so I'll just close that poll now. I'll show you, I guess, so you can get a gauge of the people online. Yeah, so over 82% on, the 50 to 65 year old age bracket, which is really the core group of people that can benefit from the transition to retirement strategy. So thanks very much for that. I'll just hide the results there and go back to the presentation. So one of the key questions that you need to understand when you're thinking about a transition to retirement strategy is the age at which you can access your superannuation. Now there's two there's a preservation age, and there's also a condition of release, and this is the key to understanding how the transition to retirement strategy can assist you. So firstly, you need to work out your preservation age. So you can look at your date of birth here and then work out what your preservation age is. If you've reached your preservation age, then you are able to commence the transition to retirement strategy. And if you're not at that age yet, then you can still think about building up your superannuation via the salary sacrifice strategy, so that when you do reach a preservation age, you can take advantage of the TTR, transition to retirement strategy. Now, this financial year, the 2015-16 financial year, is the first year in which we've jumped up in the preservation age. So anyone turning 55 this financial year won't reach their preservation age. They'll have to turn 56 to reach their preservation age this financial year. So it's the first year in which we're jumping up a notch in terms of this gradual move to those born after the 30th of June 1964 being only being eligible to access their superannuation at age 60. So that's the first thing you need to attain, so the preservation age. And I get lots of comments about, well, that's a bit of a funny name, but that's just what they've called it, the preservation age. It's the age at which you can access some of your super. The other condition that you need to meet to access your super, or determines how you can access your super, is a condition of release. So if you've reached your preservation age over here, and then but you're still below age 60, then to satisfy a condition of release, you need to be have ceased gainful employment, and you also have to satisfy the condition that you intend never to again become gainfully employed. Now, you can in the future become employed again, but at the time that you make the declaration, that needs to be your, I guess, a truthful statement. So if you're under 60 and satisfied those two conditions, then you've satisfied a condition of release and you've got full access to your superannuation money. If you've attained 60 years of age, then it's a little less stringent to get full access to your super money. All you need to have done is ceased gainful employment. There's no requirement to say that you don't intend to return to the workforce. So you could actually have two jobs. You cease one of those jobs and that would satisfy a condition of release and you would get full access to your superannuation money. And then a catch-all is when you turn 65 years of age. That's the final point in time at which you've got full access to your superannuation money. Now, how you can access your money depends on whether you've reached your preservation age and whether you've satisfied a condition of release. So if you have reach your preservation age and met a condition of release, then you can withdraw your superannuation money in the form of a lump sum payment. You just need to be careful if you are under the age of 60 that if you were withdrawing more than $195,000, then there could be some tax implications of drawing out the money under that under the age of 60. If you have reached your preservation age but not satisfied a condition of release, then you're able to access your superannuation money, but it's limited to a maximum of 10% because you have to commence what we call a non-commutable account-based pension, a pension that cannot be you can't draw money out of in lump sums. You can draw it out in the form of pension payments up to 10% of the balance. So if you've got $100,000 in your account, you can draw up to $10,000 each year, but you can't draw lump sums, but you can draw and in the form of pension payments. So they're the two different options in terms of accessing your superannuation money. So it depends on, firstly, you must reach your preservation age, but how you can access your superannuation money depends on whether you've satisfied that condition of release or not. Now you know how to access your money, then you might be asking the question, well, why on earth would I worry about using superannuation to save for my retirement anyway? Well, this chart really tries to explain that, and it shows the five sort of broad investment structures in which you can invest through. So you can invest in your individual names, joint names, within a trust, a company, and in superannuation. And with superannuation, it's divided into two phases, so the accumulation phase and the pension phase. There are other structures. There are insurance bonds, investment bonds, education scholarship funds, and annuities. But the main investment structures are these five, and so we're just going to focus on these ones for the moment. So if you were to, I guess the benefit of the, cutting to the chase, the benefit of saving for retirement through your superannuation money is that once you have reached your preservation age and can move your superannuation money to pension phase, earnings on the fund are totally tax-free. It's 0% tax rate on both income and capital gains. Whereas if you, for example, and I think I've got an example here. Yeah, so if you for example, have an income of $90,000 and so employment income of $90,000, your marginal tax rate is going to be 37 plus the Medicare levy of 2%, 39%. So if you've got $100,000 of funds to invest and they earn 10% or $10,000, the tax on that money that you're going to earn is $3,900. And if you factor in the net return, it's only after taking away the tax, you're only going to get a return of $6,100. Whereas if you're in the pension phase of superannuation, you'd get the full $10,000 return with no tax payable. So that's the key reason why superannuation is a great way to save for your retirement. Now, if you understand that, and then thinking, well, maybe I should get more money into superannuation, then the next question is, well, how much can I put in? And this is where you need to understand that there's two types of contributions. There's concessional contributions, which include both your superannuation or all of these items. So your superannuation guarantee, which is your 9.5% that your employer puts in, on your behalf. Salary sacrifice contributions that we'll talk about further, and if you're eligible to make them, you can also make personal deductible contributions. They're what we call concessional, and it's because you can generally save tax rather than paying income tax. They call them concessional because you're potentially paying less tax by utilising these types of contributions. Now, the current limit is $30,000 for those under 50 years of age, and $35,000 for those over 50 years of age. That's for concessional contributions. Now, non-concessional contributions are 6 times the standard concessional contribution rate. So currently the standard contribution rate for those under 50 is $30,000. 6 times that is $180,000 per annum. So if you are less than 65 years of age, you can bring forward 2 years of these $180,000 contribution caps and put into your superannuation account $540,000. Now, once you are over 65 years of age, then you can only put in a maximum of 1 year if you satisfy the work test, which is working 40 hours in 30 days. So just be aware of that. In terms of understanding, are you eligible for the higher limit for concessional contributions of $35,000, or are you only eligible for the lower contribution limit of, that should be $30,000, not $300,000 there. There's an extra zero. It depends on if you are 49 as of the 30th of June of the previous financial year. So if you were 49, so this is the key thing, if you're age 49 or over as of the 30th of June, then you are eligible for the $35,000 contribution limit. If you are less than 50 years of age, which means you are 48 or under as of the 30th of June of the previous year, then your contributions cap is $30,000. So that's your concessional contribution cap. Now, it's expected, this will index up in $5,000 lots over time, and it's expected that on the 1st of July 2018 that this $30,000 limit for those under 50 will jump to $35,000. So just understanding that limit is important, because if you go over that limit, there is a penalty for doing so. They've reduced the penalty significantly, but there still is a penalty for doing that. So that's the concessional contribution caps. Just to help you understand how this is going to play out in the future, if you do have large sums coming into your superannuation account, then you might be receiving an inheritance or selling investments properties that you might be wanting to get into super, then understand that previously the index concessional cap was 25. That meant the bring forward rule was the amount of non-concessional contributions you could make was 150. Therefore, in any 1 year, you could put in 450,000. We're currently at this stage where the standard concessional contribution cap is 30. 6 times that is $180,000, which means at the moment, in any one financial year, you can put in up to $540,000, but then you're prevented from putting any further non-concessional contributions in for 3 financial years. Hopefully you're appreciating that. The key thing to this chart is that as of the 1st of July 2018-19, this $30,000 amount will go up to $35,000, which means that you can put in $210,000 in any one financial year, and if you're under 65 and can use the bring forward rule, it means that it's going to jump up to $630,000. But just a tip here is, if you do trigger the bring forward rule under this limit, and then you reach the 2018-19 financial year, if you've triggered this bring forward rule, you have to wait for that 3-year period to expire before you can start to utilise the higher cap. So hopefully you can understand that. So we've talked a little bit about the rules around superannuation and how you can get money into it, the limits in getting money into it, and why you might use it. Now we're just going to touch on, I guess it's 7 steps that that can apply to most people, but In the previous webinar, of which you can get the recording of, we discussed some of the non-financial items, and the key thing with transitioning into retirement is what are you going to do with your time, because it's important to plan for it. If you don't have any plans there, then it generally has negative outcomes in terms of your psychological and physical health and your ongoing well-being. So make sure you do think about what you're going to do with your time. The other things you can start to think about are to prepare for retirement is to pay off any consumer debt. So that's car loans, personal loans, store cards. Get rid of consumer debt as soon as you possibly can. It's a standard rule of thumb for anybody at any stage of life. Ensure you have an emergency fund of 3 to 6 months living expenses. So if you spend $4,000 per month, then you should have between $12,000 and $24,000 sitting in an emergency fund. It's a good situation to be in. Save for major purchases, and that could be either the 4 key ones are buying a home, buying a car, starting a business, and education. So if you save for those things, then the focus really is paying off the mortgage and then starting to build your retirement savings. Now, you can do these a little bit in parallel, but as a rule of thumb, this is the focus that we suggest you take. And then take advantage of tax saving and asset building strategies. And this is where we're going to focus on for the rest of the presentation. So strategies that you can start to implement as you're building your retirement savings. Some key ones that we often mention here are the government co-contribution, the eligible spouse contribution. We've covered those off in other webinars, one of which is the federal budget review. So the 2015 federal budget review. Go to the Christian Super website if you want to get the recording of that, but we talk about what that is and how that works and how you can benefit from it. Today we're going to focus on the salary sacrifice and transition to retirement, and then next webinar, the one on I think it's the 7th of September, we're going to focus on these 2 strategies. So for the rest of the session, we're just going to focus on these salary sacrifice and transition to retirement strategies. So how does salary sacrifice work? There are 2 ways in which you can receive, or there's probably many ways, but if you're not salary sacrificing, your employer, before they pay you, deducts PAYG tax, so withholding tax. After they've deducted that tax, and depending on how much you're earning, the tax rating, including the Medicare levy, is either 21, 34.5, 39, and 49% if you're earning over $180,000. They'll deduct that tax first from your pay, and then they'll put into your bank account the remaining amount, and you can choose to spend or give that money. You can save the money, or you could put it into your superannuation. So that's if you're not salary sacrificing. If you are salary sacrificing, what happens is before your employer deducts tax from your salary, they put some money directly prior to the tax directly into your super fund. And on the way into your super fund, tax is deducted. And the rate at which the tax is deducted is 15%, or it could be 30% if your income is over $300,000 per year. And this is where you can see the difference of those tax rates that we saw earlier. If you can pay tax at a lower tax rate, then this is where the saving is. So what happens, your employer directs some of your income firstly to superannuation, then they deduct the withholding tax from your salary, but because it's a lower amount, less tax is deducted. Then the remaining amount is put into your bank account, and again you can spend it, give it, or save it. And this is where the key difference comes into play. So the salary sacrifice, or the benefit of it, is the difference between what your marginal tax rate is and what you could potentially be paying in superannuation. So if your taxable income is less than $37,000, then your benefit is 6% of what you're going to salary sacrifice. If your marginal tax rate is 34.5%, that is, you're earning between $37,000 and $80,000, then the benefit of what your salary sacrifice is 19% or 19.5%. And if you're thinking about salary sacrificing 10 grand, for example, that means it's nearly $2,000 tax saving just by directing money directly to your super fund. On the 39% tax rate, it's a larger amount of 24%, or on $10,000, $2,400. And if you're on 49% or earning over $180,000, if you're earning under $300,000, other than the benefit is 34%, or $3,400 for every $10,000, but then the benefit cuts back slightly if you're over $300,000 in earnings, because then the tax rate on the contributions is $30,000. So it drops back then to 19% if you're earning over $300,000. So hopefully that explains how salary sacrifice works and the key benefit of it. And so the key benefit is the difference, or the arbitrage, I guess, between what you can pay by directing your money to super versus what you pay if you receive your money into your bank account. If you want to understand it from a formula basis, then the way that you can calculate your benefit is to work out what your marginal tax rate is, the 21 or 34.5 or 39 or 49%, or even if it's a zero, if it's under 20,500 that you're earning. You take away the contributions tax rate, you need marginal tax rate plus the Medicare levy less the 15% contributions tax rate. Times the salary sacrifice amount is the benefit. So here's an example with Ben. He's 60 years of age. He earns $67,000 and he's able to salary sacrifice $28,800. His marginal tax rate's 34% when you include the Medicare levy. So the net benefit to him is $5,616. Now, he could actually increase those savings even more with the low income tax offset, because his income's reduced into the low income tax offset realm. So it could be getting close to $6,000 in annual tax savings by salary sacrificing in this particular scenario. I just have a question here from Fiona. Can you give the break-even point for each of those salaries and how much to... I can't see the rest of the... how much to sacrifice. Can you give a break-even point for each of the salaries and how much to salary sacrifice? We'll answer that in the coming slides there, Fiona, so stay tuned. Good night, John. I hope you enjoy the recording. John's hitting the sack. Just a quick question, just to keep your engagement here. How much do you currently salary sacrifice, is the question here. So if you just want to enter, I think I've covered off most scenarios, so just enter what your particular scenario is. Do you salary sacrifice at all? First three options are none, and just an explanation of the none. And then you might salary sacrifice less than the maximum allowable, or you might salary sacrifice the maximum allowable. We've got about 70% voted, so or 75%, so I might just getting on to 80, so I might close the poll there and just get a sense of how many of you are salary sacrificing. There you go. So 50% of you are still not salary sacrificing. It'll be interesting to see whether whether you are missing out on some benefit there. And if you're earning over 20,500, you really potentially are missing out on some tax benefit by not doing that. Oops, I need to close this poll again. Sorry, hide the results so you can see the screen. There we go. And I think someone did have a question. No, that's fine. Okay. So relating to Fiona's question there was, when should I salary sacrifice? Now, it's not right for everybody to salary sacrifice, and there's a few things to factor in. So if you have consumer debt, credit cards, car loans, personal loans, then really that should be the focus rather than salary sacrificing. If you do have a mortgage and you're a fair way from your preservation age, then generally salary sacrificing a lot of money into super, unless you're on a high income, might not be the best strategy. So you need to just weigh up those. If you've got debt, that should be a priority. But there is a point where either if you're on a high income and you're going to save a lot by salary sacrificing, or you're getting close to your preservation age and the age at which you can access your super, and you might be saving $6,000 in tax. Interest rates are low, and so if you're going to access your super money in a couple of years and save, $6,000 a year by not paying off the mortgage, then it can be a beneficial thing to defer paying off the mortgage, save the tax, and then once you have access to your super, pay down the mortgage a little bit more there. So, but think about, should I be paying off my debt before I salary sacrifice? It's a good question to ask. Ken just asked, how does salary sacrifice other costs such as school fees compare to into super? The difference between salary sacrificing into other things is that you generally have to spend it, whereas putting it into superannuation, whilst you do pay 15% contributions tax, you're actually saving the money. So that's the key difference. You're either spending the money or if it's into super, you're actually saving the money. You're building up an asset. But it is valid to utilise it to pay for school fees, etc. Lucy says, so I've only heard of salary sacrifice in relation to cars, computers, but you were obviously saying that you can contribute to super as a salary sacrifice. Yes, exactly, Lucy. So, yeah, often people have only really heard about salary sacrifice in terms of salary packaging, cars and computers and those sorts of things. But the key strategy here, and that's all about spending money, but the key thing here is that it's about saving money, building up your assets, and that's the key benefit of it. Paul says, if I salary sacrifice $5,000 a year, does that mean I can't access that money until I retire? No, it's at your preservation age at which you can access your superannuation money, as we explained in that chart before. Calvin says, is it worth pointing out that salary sacrifice does not apply to self-employed? Yeah, Calvin, it doesn't apply to self-employed, but you can make what we call those personal deductible superannuation contributions when you are self-employed. So there is a similar sort of structure that you can apply to get a similar outcome. Cliff says, can you salary sacrifice towards your mortgage on family home? Can you salary sacrifice towards your mortgage on a family home? You can if you're in a particular category of employment. So if you're in a charitable sector, if you're a minister, you've got exempt benefits that you can put towards your home. If you're in the healthcare industry, in a public hospital, for example, then you've got about $9,000 that you can package towards your home. But if you're a standard salaried employee, then you can't generally salary sacrifice towards your home there, Cliff. But there's some categories of employees that can do that. So before you salary sacrifice, consider whether you should be paying off your debt first. The other thing that we'll go into a fair bit of detail on here is your tax rate. If your income is less than $20,500, you're generally paying no tax, and therefore it's not worth salary sacrificing. I have some people earning $20,000. They're paying no income tax, but then they decide to salary sacrifice $10,000 of that income, and rather than paying no tax, they end up paying 15% tax on that money. So they're paying an additional $1,500 a year because they are salary sacrificing. So it's not always applicable. You need to be earning over the $20,500 figure for it to be worthwhile. Your contribution limits, we'll go into that. Don't exceed them because there are penalties. And can you afford it from a cash flow perspective? You might be saving thousands of dollars in tax, but if you can't pay for your everyday expenses, it's not a worthwhile strategy really to pursue. And the other thing to factor in is, when can you access your super? If you're 30 years of age today and you're only going to be able to access your money in 30 years, then you probably don't want to be too aggressive on salary sacrificing to superannuation unless you are on really high incomes and paid off your mortgage, for example. So let's just dig into a little bit more detail around the tax rates and contribution limits, and hopefully this answers some of your questions. So the key thing is making sure that it is of benefit to salary sacrifice. So we've got an example here of someone who earns $44,000 of income. And that means that they earn between 37 and 80,000. So their marginal tax rate when you include the Medicare levy is 34.5%. So in this scenario, if the tax-free threshold is $20,500, we could salary sacrifice right down to that threshold and get an advantage. So the idea is that we take our $44,000. Of that $44,000, we direct $23,500 of it to our superannuation prior to paying tax. There's 15% tax payable on the way into superannuation, but we've saved paying 34.5% tax on that money. And our taxable income ends up being $20,500, so we'll pay no income tax, and we've saved nearly $3,000 in tax by doing that. So there's an example of, I guess, going only salary sacrificing down to the $20,500. And Fiona, this is trying to explain how far you could go down. Don't go down below that figure is the general rule of thumb. So if your taxable income's around $20,500, you're sort of optimizing your situation. But if your income is a bit higher than this, then you need to make sure that you don't exceed your concessional contribution limit that we talked about earlier. Lucy just asked about what about self-employed, similar to Calvin's question earlier. It is a similar thing when you're self-employed. What you do is you can put into your superannuation account. If you're a self-employed person, you can put into your super account a contribution of $35,000 and claim a deduction on it. That's what this is. So the concessional contribution limit is $35,000, but it includes superannuation guarantee contributions and salary sacrifice, but also personal deductible contributions. So if you are a self-employed person, you can, rather than salary sacrifice or superannuation guarantee, the 9.5% that employees get, you can put in your own contributions to super, and the key is that you claim a deduction on it. So to satisfy this rule, you need to have no more than 10% of your total income being generated from employment purposes, and then you're eligible to make those personal deductible contributions. It's exactly the same sort of principle, but you just do it a slightly different way. You put your contribution into super, you claim a deduction on it, and then it has the same impact as salary sacrificing. So it's not that different, Lucy and Kelvin. But the point for this slide here is that you shouldn't go over your contribution limit. Let's say your income, for example, was $115,000. Our contribution limit is $35,000. Now, some people say, well, that means I can take $80,000 income into my hand, and then I can put $35,000 into my super fund. But what that doesn't factor in is that the contribution limit of $35,000 includes your superannuation guarantee of 9.5%. So in this scenario, you would have exceeded it by your superannuation guarantee amount, so 9.5 times $115,000, and you would pay a penalty on that amount. So just make sure that you understand that the superannuation guarantee is included within the $35,000 contribution limit if you're over 50, or if you're under 50, this is a $30,000 contribution limit. So make sure you don't exceed your contribution limit. Jerry says, how was $20,500 tax-free arrived at? Yeah, good question. Good question. Maybe I'll just backtrack on the slides here. So the $20,500, you're probably thinking, well, the tax-free threshold is $18,200, but there is what we call a low-income tax offset. So if you earn income of up to $20,500, because of the low-income tax offset, the tax-free threshold is actually $20,500. That's why it's $20,500, not $18,200. So, just explaining, don't go over your contribution limits because it includes your superannuation guarantee contribution. So, what the ideal scenario is, if you are on an income of $115,000, so the maximum amount you could contribute without going over your $35,000 contribution limit is the $24,075. So if you put that over into your superannuation account, that'll save you tax of close to $6,000 per annum. So if you're doing that over the next 15 years, 10 or 15 years, that's $60,000 that you're retaining in your pocket instead of paying to the government. And whilst it is fair to pay taxes, it is also a legitimate way to help boost your retirement savings, and then you're less reliant on the government later on. So 2 things. Make sure that it is actually saving tax, and you can go down to that $20,500 if you've got a low enough income. Don't go over your contribution threshold. The other thing is making sure that you've got enough cash flow to actually to afford to salary sacrifice, because basically you're foregoing income into your bank account to put it into super and save the tax. So again, on $111,000, we're salary sacrificing the maximum amount. But if that means that we've got a bit of an income gap, we really need the $111,000 to live on, then the salary sacrifice scenario doesn't work. Now, what you could potentially do is salary sacrifice less. So you could say, well, I could get by on $100,000, and therefore I'll salary sacrifice $15,000 into the super fund, but you are missing out on tax savings of a little over $2,000 by reducing the amount that you salary sacrifice. So if you have reached your preservation age, you could potentially salary sacrifice the maximum amount and then start to draw on your superannuation money in the form of a pension to make up the gap, so to fill that gap. And if you're over 60, that pension amount comes to you fully tax-free. If you're under 60, there is some tax ramifications for it, so you just need to factor that in as well. But this is the key of the transition to retirement strategy. Ken says, will you explain personal deductible contributions as part of the $35,000 limit? Yeah, personal deductible contributions are a concessional contribution. They're only eligible for those people that have generated less than 10% of their total income from employment purposes. And so this cut sometimes is relevant for those that are self-employed, or for people who have retired and sold a large asset, and then they can make personal deductible contributions. So it's putting money into your super fund, claiming a deduction on it so that 15% tax is deducted, and then it reduces your taxable income. If you want to learn more about that, then tune into the next webinar on the 7th of September, or register for that, and we go into that in a bit more detail in that scenario. Oh, great, Ken, you've got it. So how much should I salary sacrifice? Depends on your cash flow, but the transition to retirement strategy can benefit you in that respect. So what is the transition to retirement strategy? It was introduced in the later years of the Howard Costello era, and the idea was that many people were retiring prior to 65 because it was the only way that they could access their super money. So they introduced this strategy that you can access your superannuation money before retiring to enable people to, scale back work. They might go from 5 days to 3 days and draw on their superannuation money to make up the other 2 days of income. And it was the strategy was to try to keep productive people in the workforce. But the actual strategy can provide the greatest benefit when you're still working full time, because you combine the benefits of salary sacrifice and the other savings to really have significant benefits. The benefits of the TTR strategy are threefold. So one of the major ones is really the salary sacrifice strategy, as we've explained. So potentially $6,000 of annual savings in tax, depending on your particular circumstances. The other benefit is that when you are 60 years of age, then the money that you draw from your transition to retirement pension is totally tax-free. So if you're trying to make up the income gap from salary sacrificing, that income is coming to you totally tax-free. If you're between 55 and 59 years of age, there is some tax payable. What happens is that the amount that you draw from your pension is added to your taxable income, but you get a 15% rebate. So it's less than your taxable income, so your employment income, but it's not as good as when you're over age 60, and we'll look at an example towards the end. The third benefit of the transition to retirement pension is that, as we saw in that table earlier, that in pension phase, there's a 0% tax rate, whereas within the accumulation phase, there's a 15% tax rate. So this is the earnings on your fund. So we've got an example here of $500,000 in your superannuation account. If that's earning 5% income or interest, or $25,000 per annum, then the tax on that is 15% or $3,750. So by moving to pension phase, you save that $3,750 in tax, which just boosts your retirement savings more. So there's the threefold benefit of the TTR strategy. A salary sacrifice part of it, drawing a tax-free or concessionally taxed pension from the pension, and also that the earnings within the pension account are tax-free as well. Now, if you haven't met a condition of release, that is, you've reached preservation age but you haven't retired, or if you're over 60, ceased a form of employment, then you can't draw lump sums from your pension, but you can draw up to a maximum of 10% per annum. So you just need to understand those rules as well. So that's the benefits of the TTR strategy. But a number of you asked about, well, how does it actually work? And I've tried to simplify it as much as possible. So many of you will already have an accumulation account, so a superannuation account in the accumulation phase, where you're putting money into it. You're not currently drawing money out of your super account. Now, we're assuming in this scenario that we've got $200,000 in this account, and what you simply do is you leave a minimum balance, and the current minimum for Christian Super is $5,000. So you leave $5,000 in your accumulation account. With the other $195,000, you roll that over to a new account, which is in pension phase. So 15% tax on these earnings versus no tax on these earnings. So that's the key benefit of moving to the pension phase. So now you've got two accounts. Now with these two accounts, you can continue to make, if you're eligible, make your $1,000 contribution to it to get access to the $500 government co-contribution. Your employer continues to put your 9.5% superannuation guarantee contribution into this accumulation account. You might be boosting that with salary sacrifice contributions. So you continue to have this account open. You also may have insurances still in this account. So this account still works as it is, but it has a smaller balance, but hopefully growing balance with more contributions coming into it. With the pension account, it has the same 5 investment options within Christian Super. So there's ethical cash up to ethical high growth in the accumulation phase, and there's the same 5 options available in the pension account. So exactly the same investment options available to you. But in the pension account, you need to withdraw a minimum amount each year. If you're between 55 and 65, then that minimum amount is 4% of the balance. You've got to draw that out each year and put it into your bank account. Now, if you don't need that money, if you've got sufficient cash flow, then you can just choose to put that back into your accumulation account. Many people get concerned about moving to the pension phase because they say, I don't want to touch my super money, I want to keep building it. Well, that's fine. That just means that when you draw the money out, you can set it to an annual amount and you can then just direct it back into your super account. So you're not actually drawing down on it. You're just taking advantage of the tax strategy, not eating into your superannuation account. Now, finally, you'll hopefully get investment growth on your account as well, depending on which investment option you're in. And similarly, you'll get investment growth on your pension account as well. So there's the 5 investment options available on both accounts. So that's how the TTR strategy works practically. I'll just answer a couple of questions that have come through. Stephen says, just to clarify, if over 60 and go into pension phase, does that mean that all money going into super is now 0% tax? No, that does not mean all money going to super is 0% tax. That means, so your salary sacrifice money that you're salary sacrificing, your superannuation guarantee contributions still get 15% tax deducted on those on the way in. Per what we call non-concessional contributions, like the $1,000 that you might put into your account for the government co-contribution purposes, there's no tax deducted on that money going in. So just because you're over 60, it doesn't mean that there's no contributions tax. There is contribution tax, but what we're saying is that the earnings on your fund are tax-free. So the earnings on your on this account, this investment growth here, is totally tax-free. The investment growth over here is taxed at 15%. That's what we're saying. And the other thing is that the pension payments that we drew out of the pension account, they're totally tax-free as well when you're over 60. It's not that there's no contributions tax. There are contributions taxes payable when you're over 60 or under 60. It's still there. Are there fees on both accounts? Ken asks. Well, yes, Ken, there are fees on both accounts. The key difference between having two accounts, the only difference from a Christian Super perspective is the administration fee. So there's an administration fee of, it's about $83.60, I think. If you're still online, Nath, you might correct me, but yeah, it's $83.60 and annual. So by... Go on, Nath.
Yeah, we've just recently, everyone would have received a letter for the first time in my whole time, in 10 years, I think. That's gone up. That's now, it went from $1.60 a week to $1.75 a week. So whatever that equates to annually.
Yeah, okay. So it's still less than $100, I think, per annum. So the cost of $91 per annum. So the cost of having these two accounts is $91. So if you're getting more than $100 worth of benefit, then it's worthwhile considering this particular strategy. So there were a few other questions that came through. So I just clicked the wrong button. Here we go. There was a question here from Jeff, and it was, is there tax payable on the pension amount you add to the accumulation account? It depends on what format you put it in. If you're an employee, and generally the only form you can put that money in is a non-concessional contribution, and if it's a non-concessional contribution that you're putting in from your bank account to your superannuation account, there's no tax payable on the way in. So concessional contributions like salary sacrifice, employer contributions, there's 15% tax payable. If you're making contributions from your bank account, like on the government, if you're putting $1,000 from your bank account to access the government co-contribution, or you're putting your pension payments back into the accumulation account, generally they're non-concessional contributions and there's not 15% tax payable on that money. Can you still set up a pension account if working full-time but have reached preservation age? Yes, you can. So preservation age is the key thing there. The thing that you can't do there, Ken, is that you can't draw lump sums from it. You can draw up to 10% from what we call a non-commutable account-based pension, but you can still move to pension phase. Yeah, you don't have to satisfy a condition of release to implement the transition to retirement pension strategy. I think I've covered off those questions there. There was just one final thing that I was going to cover off before. Well, I just mentioned these resources. I was just going to flip to, if the thing allows me to, a fact sheet that is available on Christian. So this is a transition to retirement fact sheet that is available. If you go to Christian Super's website and go to free stuff and then publications and guides and PDSs, so free stuff, publications, PDS and guides, just here there's this transition to retirement fact sheet, and I was just going to walk through it because it might be a little bit small, but hopefully you can see it okay. I'll just try to zoom in a little bit maybe. There we go. What this is trying to explain is the tax benefits and the difference between being 55 and being 60 years of age. So we've picked an example here of someone who is earning $80,000, and in this first column there's no salary sacrifice, and the net outcome is that there is 71. It keeps on changing when I go down there, but 71,563. So that's their net benefit. If you're under 55 and you start to salary sacrifice, so I think the maximum amount might be 27,400, then because of all the tax savings, etc., then the net benefit of that particular strategy is 77,117. Now, if you look at this third scenario where there's salary sacrifice, but this scenario is showing that you're salary sacrificing, but you still need to maintain your current level of income. And in this particular scenario, it's slightly less. The benefit is slightly less than that of just salary sacrificing, not moving to pension phase, which is an interesting one to just take note of. So if you can, it's not always the optimal strategy when you're under 60 years of age to move to pension phase, depending on the mix of your assets and what you're going to draw from it. But generally, if you're under 60 years of age, I implement the strategy of you roll to pension phase, but you draw the minimum amount possible. So you draw the 4% from it. If you're salary sacrificing a lot in excess of that amount, then it generally salary sacrificing and moving to pension phase works. But then if you look at once you turn 60, because the income that you're drawing from your pension, your transition to retirement pension, is totally tax-free at that point in time, that by far gives the best outcome here. So $77,000, nearly $78,000, the better of the four, or the best outcome of the four scenarios. So that fact sheet is available to you, so you can go to that website. The other thing that the fact sheet does have on it, if I can scroll across to it, it's just got a few questions about things to consider. So if you want to look at that fact sheet, it might be another helpful hint, as well as potentially going back over the recordings as well. Now, just going to flick back to other resources that are available here for you. So there is the Christian Super Help Desk. So if you just need forms to implement some of the strategies because you understand them, then you can call the help desk. A lot of the forms are available via the Christian Super website. You can either register for future webinars or look at previous recordings of other webinars if I've referred to them through the session. If you want personal advice, if you want us to sort of help you through it rather than do it yourself, then you can contact us via the website or call us. But now I'm just going to walk through the other questions that people had or registered with when they registered for the webinar, and answer your questions online. So continue to fire your questions through via the question section. I'll answer them until there's no further questions, but whilst there's none, I'll just continue to walk through the dozen or so questions that we have on registration. And Nath, if you've got anything else that you wanted to add, then feel free to chip in as well.
Yeah, well, just on the resourcing and the Christian Super website, as well as being able to access the forms on the website, when you log into your secure logon on the website, you can actually perform a lot of the functions that you would otherwise perform on a form straight online. So if you want to change the investment options, you can do that online. If you want to update your address, you can do that online without actually needing to complete a form. If you want to roll over super from another super fund, you can do that online. So while there are a few things like applying for additional insurance or applying to withdraw your benefit where you actually need to complete a physical form, a lot of the stuff now you can just do through your secure online login.
Yeah, and if you haven't already got an online login, then it's just a matter of going to the website and clicking on member login, and you can register for your own access to your own account there. So I think you get where is it? Somewhere down here. Register for member access. Click here to join, and you can walk through setting up your own particular access to your account. Yeah. Thanks, Nate. That's a good point. Yeah.
Yeah, that's right.
So just getting a couple of questions coming through. So Jenny says, could you please answer my previous question as Had to go and dish up my husband's tea. Oh, you're a kind wife. Your previous question, I just need to try and look back and find it. Jenny, I think it was, my husband has just joined Christian Super and is rolling his super out from his current fund into Christian Super and is setting up a pension fund. Does he have to wait to withdraw the 10% balance? Is there a waiting period? So if you've rolled over to your from another fund to Christian Super, you're in the accumulation phase, then if you want to access up to 10% of the balance, then you need to roll over from the accumulation phase to the pension phase, and at that point you can choose to draw up to 10% of the balance. You can draw it in one payment, in an annual payment, or you can do it monthly, fortnightly, quarterly, however you want to draw it out.
But once the pension account's set up, there's no waiting period at all. Once the pension account's set up, you can do that drawdown. As soon as it's set up, you can do the drawdown. There's no, you got to be in it for 3 months first or something, anything like that. Yeah,
exactly. Thanks, Nathan. That's exactly right, yeah. Ken says, thanks, very helpful. My pleasure. Andrew says, we have an investment property plus our own home. We are 2 years from retirement as the second home mortgage is interest only. It needs to be sold. What happens with the capital gains tax? Do we sell before or after retiring? Register for the next. Sorry to sort of defer you, Andrew, but we go into a fair bit of detail on that on the next webinar. So that's the 7th of September. We'll go into that in a fair bit of detail. Depending on your circumstances, sometimes it can work to, if there is a significant capital gain and you're still able to contribute to super, then doing it after you retire actually can work quite well. But register for that next webinar, and we'll go into that in a fair bit of detail. Jenny says, can you choose what accounts at your bank to have those payments to go to? Yes, it just needs to be an account that it's at least got the person whose pension account it is name on it. So it can be a joint account of the pension holder or an individual account of the pension holder. It can't be the spouse's individual pension account. Cheryl says, thanks very much, Gavin and Nathan. I need to head off now, but it was very informative. Cheryl, our pleasure. Andrew's no problem. We might catch you at the next webinar. No more questions online there, so I might just flick through. Oh, did one just pop up? We did. Sorry, Calvin, I just about missed you. When transitioning over 60 years of age, do I have to cease work or go to part-time? No, you don't have to cease work even if you're under your preservation age, Calvin. The key thing to start to implement the transition to retirement strategy, so that is move your superannuation to pension phase, the key thing that you need to do is just reach your preservation age. You don't need to have ceased work. You don't need to have reduced your work. You can do it at any point in time. Andrew says, minimum TTR pension. The minimum amount, Nath, I was trying to, is it
$20,000.
$20,000. So to move from the accumulation phase and start a pension account, you need to at least have $20,000 to do it with. So if you need to keep a minimum of $5,000 in your existing super account, then you need to have like $25,000 in that account to get it over to pension phase. Rob, just double checking, I can take a lump sum once a year from the pension fund, not take a regular payment. No, Rob, you can choose how frequently you have payments. So you can, often people like to, if they're wanting to set it up so that they've got the same take-home pay as they're currently got, so they're salary sacrificing and saving tax there, and then drawing money from their pension account, they like to actually set it up so that there's no change to when they weren't salary sacrificing and drawing a pension. So they set it up at their usual pay period. So you can set it up to be a fortnightly payment, a monthly payment, quarterly payment, or if you prefer, you can set it up annually as well. So there's the full flexibility there. Stephen says, thanks, Gavin and Nathan. Got to go. I will register for the next webinar. Our pleasure, Stephen. Thanks for joining us and look forward to the next one. Chris says, thank you and goodbye. Chris, I think I've got a question that hopefully I've answered, but I think you're the first cab off the rank of the other questions that I had here. Oh yeah, I think I might have answered it throughout the sessions, but wouldn't it be better to just pay off the mortgage? It depends on how close you are to your preservation age. So if you could, for example, save $6,000 tax, like the example we had for Bill, I think throughout the presentation, and you've only got a couple of years and at which you can access your super money, it's better off. And then you could put that money against your mortgage at a later point in time. I think you're better off taking advantage of the tax savings strategy, pay the low interest rates, and overall you're probably better off. But if you're 30 years of age and you've got 30 years until you can access your super money, then yeah, focusing on the mortgage is often a better strategy than salary sacrificing too much to super. Oops. Calvin says... thank you and good night. Yeah, you're welcome, Calvin. Graham says, thanks, Gavin. It's so much easier to understand everything when listening to the presentation. Graham. Yep, our pleasure. That's what we're here for. Thanks for joining us. Fiona says, LSX, what's that mean?
Is there a website where you can enter various factors and see the end results?
Is there a website where you can enter various factors and see the results, a bit like a mortgage calculator? Yeah, there are some. There's one I mentioned last time, which is a government site. Equip Super doesn't do it, does it, Nath? Doesn't do TTR.
Christian Super Equip, no. Yeah. So Christian Super Equip does do TTR, but it wouldn't consider things like your mortgage. Potentially the government smart money website has some calculators that can do that. Or
yeah.
Money Smart, sorry, yes.
Yeah, Money Smart.
Money Smart website.
Yeah.
Has some tools that could do that.
So it's under...
the alternative is there you go.
It's under calculators and retirement planner. And it does factor in both the age pension, and you can adjust it for, if you're saving more or salary. I think it includes salary sacrifice more, but you basically just got to put in all your details, and it says, what's your age, what retirement age, and then employer contribution. If self-employed, put 0. Do you make extra contributions? If you click yes, so then you can up your salary sacrifice amount, and so it does.
I misread for you. Yeah. Christian Super website has one of these as well, and Christian Super Equip, you could put in specific details. I realise you're not saying you want it to factor in your mortgage. You're just saying about TTR. Yes. So if you log into the secure online website, you can actually do a full. It probably takes. On our public website, there's a simple one in the free stuff, where a simple retirement calculator. Or alternatively, if you log into the secure web, you can use the Christian Super Equip limited advice program, and that'll be like a 20-minute asking you questions to get in depth. Yeah.
So check that out. So log on to your account online and then click on Equip, Christian Super Equip. And that's got the modelling software there. This government one, the Money Smart website, does factor into the age pension. The other one that's on the Christian Super website, I think I found it before. Where was it? Was it financial advice? I can't remember. There's the Equip, so you can click on Christian Super Equip. There was one other calculator I did come across. The difference between that calculator and the Money Smart one is that the Money Smart one does factor in the age pension as well. So yeah, a few different resources there that you can check out. I'm just trying to find that other calculator.
Yeah, is it?
I came across it just looking at stuff before. Yeah, but anyway, there is one there. If you find it, Nate, then let us know and we can point people in that direction.
Yeah, I'm having a look. I can't find it either. Here it is. Free stuff, retirement resources. Super
So
calculator.
free stuff. Oh, retirement resources. Yep.
Retirement resources. Yeah.
And then it's a super calculator, and so you can put in all your details there, and it'll. But this is if you're sort of self-sufficient. It doesn't factor in the age pension as what I've found with this one.
Yeah.
So it's kind of if you're not relying on the age pension, you're just relying on your full your assets entirely yourself. Which is, if you've got assets less than 1.1 million other than your family home, or from 2017, you've got less than 823 as a couple, then you're likely to receive a part pension, so that impacts this particular scenario. Noel says, thanks, some salary sacrificing may help me save some tax this year. I would have last year. See you next time. Our pleasure, Noel. Fiona, sorry, typo. Oh, that's okay. Nath sorted me out, Fiona, with the typo. Ken says, thanks, guys. Very clearly explained. Much appreciated. Good night. Thanks, Ken. Good night. Kayleong, thank you. Our pleasure. Jenny says, well done, guys. Very informative. Thanks for your help. Our pleasure, Jenny.
See you, Jenny.
Excuse me, but I can't pronounce the name. Can you pronounce the name there, Nath? Just pointing us to the Money Smart website from ASIC. Yeah, that's a good one. Fiona says, thanks very much. Our pleasure. And Key said, thanks. Our pleasure. Thanks very much. If you've got questions, there's still 34 of us online. So if you've got other questions, please forward them through. If you want to do an audio question, pop up your hand and I'll open your line and we can ask it you can ask the question verbally. But I've just got a few other questions to cover off at the end here. And Nate, feel free to chip in with anything at any time. Ros asked the question, do I need to commit to a specific date to retire in order to implement the transition to retirement pension? No. You don't need to commit to retirement. That's the whole idea, is that you don't have to retire. You don't even have to scale back work. So you can start it once you've reached your preservation age. Peter asks, when you go over to transition to retirement, what actually happens with the super fund? Do I get interest on the money that is there, and at what rate? You do get interest on the money. There are the same 5 investment options, and depending on what investment option you invest in, you'll get a different rate. So the cash rate's probably between 2.5% and 3%. Ethical high growth in the last year was above 10%, Nath. So it depends on which investment.
Bringing it up on the website itself too.
So depending on which investment option you chose, then it's a different rate of return. But there's the 5 different investment options available.
And generally speaking, the pension options will either they perform better than the accumulation options slightly because they don't have to pay the tax in good years, and slightly worse in bad years because they don't get the tax rebates in bad years.
Exactly. Yep. Michael says, thanks, guys. I hope to tune into the next webinar. Thanks, Michael. Our pleasure. Rob says, thanks a lot. Appreciate the information. We'll log into the next webinar. Looking forward to that, Rob. We'll see you then. And so Peter had a long question, so I've divided it into 3. So Peter's second question was, what are the pros and cons of taking a lump sum of your super and investing it with other financial institutes like banks? Well, the key thing is the investment structure. So getting back to our investment structure chart, is if you're pulling it out of super and you could have that money in the pension phase of superannuation, the negative thing of pulling it out of the pension phase of super is that if you're then going to invest it in your own name, you could pay some tax on it. If there's some capital gains on the investments, then you could pay some tax on that money as well if you invested in your individual name. So pulling it out of super, pulling lump sums out of super and going investing it elsewhere, just from a structure perspective, not thinking about the underlying investments, particularly if you're close to retirement, isn't often the smartest idea. But I guess it depends on the after-tax return, what that return can be. But generally at retirement, having money in the pension phase of superannuation, because it's 0% tax, and when you're over 60, what you draw from it is tax-free as well. It's often a better way to go. But you can do it though. You can pull out lump sums and invest it anywhere you like.
When it's investing, you got to weigh that up. But on the paying off debt side, members often will, when they can get access to it, pull it out to pay off debt, and that may save them on their own cash flows. But when it comes to investing, the way the government structured the tax incentives in super makes it difficult to get comparable returns outside of super.
Exactly.
Once you factor in tax.
Yeah, if that was to draw a lump sum to pay off a mortgage, for example, and eradicate debt, then that's a reasonable strategy. But if it's to go and invest in term deposits or other bank investments, then that might be a little less beneficial, depending on what your marginal tax rate is. Peter had a third question, which was, what are the pros and cons of annuities? An annuity is basically where you provide a life insurance company, effectively, a lump sum, and they commit to pay you a set amount for a period of time. Now, that period of time could be, say, 10 years, or it could be for the rest of your life. And so what you're doing is you're handing over responsibility of the investments to the life insurance company, and they're committing to pay you a certain amount of income. The pros and cons of that is that you're guaranteeing a particular return for a particular period. The drawbacks of it are that often they've got to be set at reasonably low rates so that they can be the life insurance companies can guarantee a return on those monies. But sometimes a combination of those strategies can work well, where you've got some in a market-linked type product, like an account-based pension and an annuity. They can be combined together. And I think, Nath, you're investigating actually having a form of annuity in the future available through Christian Super, yeah?
Yeah, we are in some early investigations into that. The government has had some recent reviews on tax and on super that have indicated that they believe, the reviewers have indicated that they believe that's a direction that the retirement system should go, where through super you can, from the day you enter the workforce to the day you pass away, the super should be able to be the one-stop shop. And so it's sort of not that the government's responded to these reviews yet, but sort of already, as a fund, we're already thinking about what sort of options are there for us to offer our members, what's going to be the best value for the members, and most assist our members in having purposeful retirements. So it's something we're looking at.
But probably a little way off, yeah.
Yeah, there's no real commitment I can give there. Yeah. We've been in discussions with Challenger, who's the biggest annuity provider in Australia, about what products they have and how that could potentially tie in with the super product. But there's absolutely no pipeline even yet on implementing a product. This is just initial investigations.
Yeah, thanks, Nath. So that's Peter's question. Norma asks, hi, just wondering what the cost is to see someone to go through this process. Regards. Oh, I've just put the surname in there. Didn't catch that the surname was in there. Norma, the best way to explain that is going back to this chart up here. And you could go to a local advisor, or if you used us, the way that we structure it is that we have you complete a questionnaire. The cost of this discovery meeting here is currently $385. Generally takes about an hour to an hour and a half. And we basically discuss the pros and cons of a range of options available to you. If you want us to help you implement a transition to retirement strategy, then we'll quote you on what that would cost at this point in time, help you implement and provide ongoing advice. So it's hard to say exactly what that would cost because it's different on everybody's situation, but the initial consultation at least is $385. So thanks for that question. Just trying to find. No, that's. And then Richard was the next question. I'll be 65 in January and would like to withdraw a partial amount of super, even though I will continue to work and contribute. Also, if you are, so the question is, well, that's fine. If you've hit your 65 is the age at which your condition of release sort of catch-all rule comes into play. And so at 65, your super money comes fully eligible to you. If you're drawing it out at that point in time, you're over 60, so it's totally tax-free as well, so that's fine. The other part of it, Richard's question was, also, if you are just overseas holidaying, how long can that be before residency is affected? Now, residency, I'm assuming that the question relates to tax. There are a number of layers of rules about whether you're a tax resident or not. One of them is if you're living more than 6 months overseas, that can affect your residency, and that you could become a non-resident and then pay tax from the first dollar of earnings. But I'm not sure whether, Richard, your question also might relate to if you're on the age pension, and at what point in time do they then start to stop paying a pension. That's a little bit more of a complex question, but I think it's after 6 weeks that you start to not receive, so the pension supplements start to cease, and then how much you get paid beyond that point in time from an age pension perspective depends on how long you've lived in the country between the ages of 16 and 65, and also whether you were on the age pension for 2 years before you went overseas. So a bit more of a complex a question there, but hopefully that's assisting.
I just noticed Richard's actually got his hand up. He may want to talk to you.
Oh, okay, thanks. Richard, did you want us to open the line to ask your question or clarify a question? I'll just...
it's gone now.
That's fine. Was it? There we go. Yeah, okay. We'll give it a go, Richard. We'll unmute your line, and if you want to ask a question, go for it. It's your line's open if you've got a mic.
Yeah. You can hear me then?
Yes.
Yeah, no, it was particularly to the pension itself. Like, I was thinking, if I, take pension, but then go overseas and not actually working overseas, just holidaying, how long can you actually be on holidays overseas before pension is affected?
Yeah, I had that in... I'm struggling to remember it. Off the top of my head, but I'm pretty sure it's in this other presentation, so I'll pull it up if I can. These were the federal budget changes, because they did change the rule as taper rates, etc. Living overseas from the 1st of Jan.
Living overseas. The
period absent from Australia will be reduced from 26 weeks to just 6 weeks. After being absent from Australia for 6 weeks, pensioners who have lived in Australia for less than 35 years will be paid at a reduced rate proportional to the period that they've of their Australian working life residence. That's the 16 to 65 year. So if you've been living in Australia for 35 years, then your pension supplement will reduce after 6 weeks. But if you've been in Australia or an Australian working life residence for 35 years between 16 and 65, then you still should get the full age pension, regardless of how long you're overseas. But there also is another rule. Importantly, pensioners with an Australian working life residence of 35 years or more who are exempt from proportionality rules will not be affected. This used to be 25 years, but they've just increased it to 35 years, I think a budget ago. And then secondly, there also is another rule that if you've just applied for the pension, so you turn 65 and or 65 and a half, whatever your pension age is, and become eligible for the pension, you also need to be in receipt of that for 2 years before you go overseas as well, because that can impact it as well. So the best thing to do if you're unsure about that and you're thinking about going overseas for a while, Richard, is just to either make an appointment with a financial information services officer, or at Centrelink, or there is an international division of Centrelink who can answer these types of questions as well. You might need to be on hold for a while, but you'll at least get through to the right person at that point in time.
Okay, thank you. Yeah, no, we certainly spent more than 35 years in Australia. We're currently in Germany, but yeah, I just wondered. I've certainly spent more than 35 years of working life paying tax.
Yeah,
in Australia.
And you need to apply for the pension when you are in Australia. You can't apply for it when you are overseas. They'll sort of see that you're out of the country and say this application is invalid because you're not here. So you've got to be back in Australia to do it. Yeah, you're in Germany now, are you, Richard?
Yeah, that's correct.
Oh, thanks for joining us. That's great. Any other questions at all there, Richard?
No, thanks.
Great. Okay. Thanks for the question and doing an audio one. That's great. Anyone else who wants to ask an audio question, please feel free to put up your hand using the control panel and we'll open your line like we did for Richard. Otherwise...
Fiona's just done a follow-up question. Is the 35 years consecutive years of Australian working life residence?
No, it's not consecutive years, no. So it can be a disjointed number of 35 years, yeah. I'll just flick back to those other questions that we had. So that was Richard's question. I think there's only a few more left, and then we're done. So that was Richard. Paul says, my wife has about 25,000 in a super fund with another crowd. She is 55, no longer works, and is wondering if she can take that money out and use it towards paying off the mortgage. Depends on what her date of birth is and whether she's actually reached her preservation age. If she was 55 last financial year, then she would have potentially reached her preservation age. She could withdraw the money. If she's withdrawn no other money from superannuation, she'd sit under a lifelong cap of $195,000 this financial year, so she could potentially draw it out tax-free and put it against the mortgage. But just check the details with the other fund first. And then if she does, will she have to pay interest on it? And if so, how much? I think you mean tax, not interest. Generally, you wouldn't need to pay tax on it if it's under that threshold. But just check that before you make the withdrawal with your other fund. And that was the last question, so we've covered it off. I think there might be one other one online. Cliff says, thanks guys, very helpful. Look forward to the next webinar. I'm off now. Good night, Cliff. Thanks for joining us. And Fiona says, that's your question that you asked, Nath. So if there's no other questions, I think we're done, and I think it's the earliest webinar that I've done, Nath. So normally I go till about 10:30 at least, and so we've finished half an hour early, which is, I think, largely related to the fact that we've cut down the content by breaking what I used to do in one webinar into 3. So yeah. Thanks so much for your input too, Nathan. It's great to have you on board.
Yeah, no problem. I think it's a great initiative, and I want us to be more, to make sure we're still involved, we stay involved and stay listening to what our members' needs are.
Yeah, great. Andrew's just saying thanks. Great to join us, and hopefully you can get to the next one where we talk about capital gains tax, Andrew. And Richard said, thanks, guys. Our pleasure. So on that note, thanks for joining us, and we'll sign off here, and hopefully we'll see you at another session in the future. Good night. See you, Nathan.
All the best. Blessings. Bye.
Yeah.